Bismillahirrahmanirrahim. I'm Majidullah Khan. Subject is financial statement analysis. And today lecture is on analysis of financial statement. This is lecture 14 as scheduled in a semester, while online. This is first lecture, online lectures. In this lecture we will cover the topic why financial statement analysis. What is financial statement analysis? Different technique of analysis, common size or vertical analysis, trend analysis, and ratio analysis. Keep in mind that these three techniques need separate lecture. It will be covered in a separate lecture. This will be covered in a separate lecture or two. Ratio analysis need 4 to 5 lecture. But in this lecture, I will give you a brief introduction of these technique. Why financial statement analysis? Since there are different type of user of financial statement, some are internal. Internal means the management, the employee, the trade union, and external, the investor and lenders use financial statement analysis. So these there are some other external user of the financial statement analysis, such as government agencies, regulatory bodies of the state. So they have different need of information. Identification of the user have significance because in financial statement the company have to keep in mind that what relevant information should be provided to all these user of financial statement. So these external and internal have different need of information. They basically use this financial statement analysis for further decision making process. For example, briefly, this is an example. Supplier is outsider party. Why it would be interested in the firm's financial statement? Because they are interested to know that is the company is in the position to find its short-term obligation, because the supplier sometimes provides goods to the companies or to the firms on credit basis. So he will be interested in the firms or the company that whether it have ability to pay its short-term obligation or not. For example, this is ABC company. ABC Limited. And this supplier supply him raw material or goods on credit, so he will be interested in his short-term short-term obligation paying ability. Similarly, why would bank be interested in financial statement or any other lenders in the financial statement? Because they are just interested to paying ability of their firms, paying ability of interest and as well as principal amount. So they will check or examine the company with this perspective that whether it is in the position to pay interest or as well as the principal amount. Now, why the shareholder will be interested? They are the real owner of the company, and they are the prime user of the financial statement, because they want to know about growth perspective of the company. They want to know its dividend paying ability. They want to know about it other transactions such as related party transaction. They want to know about management. They want to know the performance of the management because they are the real owner of the company. So they need annual or financial statement, annual report or financial statement of the company. They have different need of information than the other people, because they are the owner and they want to see many things that the management are performing on their behalf. Moving further, what is financial statement analysis? First of all, let me give you one example, that there should be a meaningful relationship, meaningful relationship between different item of the financial statement and analysis. So the analysis is basically, it is the process of investigating the relationship among financial statement element and making comparison with relevant information. This conveys the meaning, elements, relationship, and relevant information. Let me explain. This relationship should be meaningful. Relationship among words, relationship between the financial statement element. Let's suppose sales and net income. These are two elements of income statement. So if we know that net income is 10% of the sale, what it means? It means that if we sell 100 rupees, 100 rupees sales will give the company the earning of 10 rupees. So it is a meaningful information. Sale versus CGS, cost of goods sold. It means if sale is, let's suppose, 100 and CGS is, let's suppose, 60%, it means that the things which we are going to sell have a cost of 60 rupees. It is a meaningful information. These are two elements of the financial statement, but it doesn't convey any meanings unless and until when we do not compare it with the relevant information. Relevant information, maybe we compare it with the previous years, past years, with the peer firms, that is competitor to your company, or the third one is industry averages. We can compare these ratio or these information with industry averages. So these are the three things that we can compare with our performance with these three things: past performance with peer firms and industry averages. Valuable tool used by investor and creditor, financial analyst and other in their decision-making process related to stocks, bonds and other financial statement. It means that financial statement analysis is one of the valuable tools. It is used by investors who are investing in the company, shares, creditors like bank, financial institution, and financial analyst who provides consultancy services. Why they are use this tool? Because they make their decisions on basis of these analysis and related to stock of the company, whether to buy or to sell the company stock, whether to buy or to sell the company bonds and other financial instrument. What is the goal of financial statement analysis? What is the objective? Financial statement analysis is to assess past performance, because annual reports are made at the end of the fiscal year or financial year, and then current financial position are assessed. Both two things, past performance and current financial positions are assessed. Why? To make prediction about the future performance of the company. So we will assess past performance, analyze or investigate past performance, then we will have eye on current financial position of the firm. Then we will be able to make any prediction or make any expectation about the performance of the company. So, useful information by comparing the company most recent financial statement with the result in previous year and with the result of other companies in the same industry. So, when we are going to analyze any company, as I told earlier, that the companies may compare their performance with the recent past and as well as with the other companies in the same industries or any competitors. Moving further, technique. Primarily, there are three types of technique financial which is used to analyze the financial statement analysis, which is horizontal analysis, vertical analysis, and ratio analysis. Horizontal or common size analysis, vertical analysis or trend analysis, ratio analysis. We will discuss briefly here these horizontal analysis, vertical analysis, and ratios analysis in the coming slide. Common size analysis. What is common size analysis or vertical analysis? In vertical analysis, the analyst calculate each item on a single financial statement as a percentage of the total. Let's suppose in balance sheet we will calculate each item of the balance sheet like cash, inventories, account receivables, non-current assets, property, plant and equipment. That should, every item should be expressed as a percentage of the total. Total means total asset. In income statement, each item of the income statement will be expressed as a percentage of the sale. So sale will be considered as 100%. Why it is called vertical analysis? It is called vertical analysis because this total asset becomes 100%. Then we calculate every item is a percentage as it is reported in a vertical form. So we call it vertical analysis. Vertical analysis applies because each year's figures are listed vertically in financial statement. Total, what is this total? This total is basically used to analyze on the income statement and is net sale or revenue. That should be considered as a total, as I told you earlier. Sale will be considered 100%, and then each item will be expressed as a percentage of this sale. While on the balance sheet it is total asset. This approach to financial statement analysis is known as component percentages produces common size financial statement. It is also called common size analysis because that is everything is component of the total asset, which is called common size. So component percentages is become then the total of the total asset, while in case of balance sheet it become total of the sales. When we calculate each item as a percentage of the sale, let's suppose of 2019, we compare sale is 100%, CGS is 60%, GP is 40%, we will be in a position to compare it easily with 20 figure. So then we will be able to provide any to make any decisions. It is one of the benefit that more easy these common size analysis is more easily compared, whether across the years for a single companies or across different companies. In balance sheet, this total is total asset equal to 100%, as I discussed earlier. Each asset is stated as a percentage of total assets. Similarly, in balance sheet on the liability sides, this total liabilities and stockholder equities are assigned 100%, and each liability or equity item stated as a percentage of the total liability and stockholders equity. While in case of income statement, this 100% is assigned to total sales, while all items of expense revenue with all revenue and expenses account related to it. So if this is sale, that is 100%, cost of goods sold will be 60% of this, gross profit is 40%. We will calculate each item with respect is a percentage of the sales. Moving further, trend analysis or horizontal analysis. Analyst always compares financial information for 2 or more than 2 years for a single company. The process is referred to as horizontal analysis. Let's suppose that is 2018, 19 and 20. Now sale is, let's suppose this is called base year. We will express the sale of other years as a percentage of this sale. So the analyst will compare the sale figure across the year rather than across the item of the financial statement. In comparing financial statement for a number of years, the analyst may prefer to use a variation of horizontal analysis called trend analysis. So when analyst going to compare these time series data of sales or any other figures, then we investigate the variation in these time series analysis. Then we are able to deduct that whether any trend or exist or not. So in this case, it is also called trend analysis as well. So trend analysis involves calculating each year financial statement balances is a percentage for the first year, also known as base year. So in this case, let's suppose you are going to analyze data from 2018 to 2020. In this case, the base year will be 2018. We will express each item of the balance sheet and income statement is a percentage of this base year. Similarly, if you are going to analyze your data from 2000, let's suppose 5 to 2020, then the base year will be 2005. We will express each item as a percentage of the 2005. The base year figure is always equal to 100%. Each things in income statement as well as in balance sheet will be expressed as 100%, and then the percentage of changes from the base year can be determined. But as I told you earlier, the time series analysis a financial statement covering more than one accounting periods. So it is also called trend analysis. Ratio analysis. It is quantitative technique. Again, it is very meaningful relationship between the items of the financial statement. So ratio analysis is a quantitative method of investigating the company's liquidity, operational efficiency, and profitability by studying its financial statement, such as balance sheet and income statement. Now, when you calculate these ratio, then analysts also use a comparative data, that how company is performing over a time. This is first and can be used to estimate likely future performance. For example, you can let's suppose there is one ratio which we call current ratio, and you analyze it is 2005 to 2020. Then compare 2005, 6, 7, 8, and then you will be able to predict the future performance about the current ratio of the company over the past data. So this can also be compared with time, as well as it can be compared with industry averages as well as other firms. As I told you, that when you compare any ratio, when analysts calculate any ratio or any other trend analysis or vertical analysis, then it will be better for them to compare it with time, with other firms, with industry averages. Otherwise, it will be hard for the analyst to deduct any conclusion from the ratio analysis or other analysis. Generally, ratio are typically not used in isolation, but rather in combination with other ratio as well. So you have to keep the overall position of the company. Then individual ratios in isolation will not provide any clear picture about the company. So it should be used in combination with the other ratio as well. Ratio analysis. There are various kind of ratio analysis, but it can be broadly grouped into 5 categories. Some book have categorized in 6, while some categorize it in 3, but mostly authors and mostly books categorize these ratio into 5 groups. First group is liquidity ratio. What is liquidity ratio? This ratio is about to show the ability of the company to pay off its short-term obligation. Is the company in a position to pay its short-term obligation or not? This liquidity ratio is all about short-term obligation paying ability. So it includes current ratio, quick ratio, and working capital ratio. Leverage ratio. What is leverage ratio? Leverage ratio compares company's debt level with its total asset of the company, that how much assets are financed by debt. It includes debt to equity ratio, debt asset ratio, and interest coverage ratio. There may be other ratio as well, time, interest on, etc., etc., but we will discuss it later. Profitability ratio. It includes profit margin, return on assets, return on equity, return on capital employed, and gross margin ratio. Efficiency ratio or activity ratio. It shows, or it answer to the question that how efficiently company uses its asset, how efficiently company uses its asset and liability to generate sale and maximize profit. It includes turnover ratio, inventory turnover, and days sales in inventory. And the fifth one is market perspective ratio, commonly used ratio in fundamental analysis of the stock. There are basically two types of analysis in stock exchange. One is called fundamental analysis, which is based on the analysis of the companies, while second is technical analysis, which is also called chart techniques. Are it is purely on the time series of the shares. So in fundamental analysis, these ratios have a key role in fundamental analysis. These includes dividend yield, price earning ratio, earning per shares, and dividend payout ratio. This is all about today's lecture. Thank you. See you in a coming lecture.